Hello, my name is Andrew. In today's video, we will clearly analyze the block order. I will explain how it is formed, tell you how to correctly identify it, and also help you understand the factors that should be taken into account for its use. In this video, you can compare the information with other video lessons that you have seen before. Personally, I use the order block in a completely different context. This gives me a high variability of use and a deep understanding of how the order block works. In this video, the material will be clearly presented to understand what the order block is. What is an order block? This is a candle that shows the purchase or sale of large capital. When forming a bullish order block, accumulation or reaccumulation takes place with the aim of future markup of the asset. In the short scenario, everything goes the other way around. Discount. After a large volume trade, traces of smart money remain on the chart. Thus, we will understand in which direction we should open a position. Here, the diagram shows a bearish order block. This is the last bullish candle which removes liquidity for buying, after which absorption occurs. Here we can already think about opening a short position while waiting for his test. The stop is placed above the shadow of the last higher candle, because if the price goes abroad, then the order block will lose its relevance. In addition to withdrawal of liquidity and absorption, we take into account auxiliary factors of its formation, which will give us a much higher probability that this order block will work. We always want to see the price, after the liquidity update, reach a problem area from which there can be a reaction and a reversal. We also want to see that after the withdrawal of liquidity and the formation of block orders, we saw a sharp drop or rise in price along with a breakdown of the structure. Try to use the rules listed above to enter a position with a higher probability of remaining profitable. The start of the order block and 50% will be considered as trigger points. To detect 50% of the block order, you need to draw a Fibonacci grid. After the block order test, we open a short with the first target to the point where the growth or depreciation of the asset began. Well, why does the price return to the zone of the order block? And why is there a reaction from her? The smart money moves the price back to the order block in order to lock in their long positions at no loss. Usually, before entering the order block area, local liquidity will be removed. After that, we place a take in the place where the movement into the area began, thereby removing the stop losses of traders. There are no coincidences here. Every movement has its own logic. The basis is always liquidity and inefficient pricing. These are the real reasons why the price falls or rises. Let's move on to the bullish order block. There is no point in lingering for a long time because the logic of bullish movements is the same as bearish. If we conclude, then the order block is your zone of interest from which we can look for entry into the position. The main criteria for formation are very simple: withdrawal of liquidity, absorption, additional rules, OTE zone test, imbalance, breaking the structure. And in the next lesson, we will talk about inefficient pricing, imbalance. See you soon. Goodbye.